Hi, welcome back to Estate Planning Using LLCs for Professionals. My name is Barry Haimo and I am your host. Today we are talking about income taxes and issues with trusts and LLCs. So oftentimes I hear from clients like, oh, I don't want to have a trust on my LLC because that's bad. And I ask them questions and they tell me all the things that they saw online that say it's bad, and that's usually wrong. So I addressed in an earlier video about operating agreements and making sure that particularly triggers are tied to the trustees or the partner that you really care about, and making sure that when the trust succeeds to the next generation, spouses and kids, like we're addressing what needs to be addressed and it's not overlooked. But when it comes to taxes, there's some interesting issues. So while you're alive, a grantor trust can own an LLC, there's no issue. It's black and white. But when you pass away, your LLCs that are taxed as an S corporation, as I mentioned earlier, cannot be owned by non-US citizen humans. So you have a trust, which is a non-person, not a natural person, that is its own taxable entity, is an owner of an LLC taxed as an S. It's a problem. But there are two solutions. Two. Number one, you'll find it in a lot of good trusts, a QSST or a qualified subchapter S trust under IRC 1361 to retain that S election status of the company and not to destroy it and cause a lot of problems. You have to comply with a couple of rules. The trust needs to be structured properly. Some of those rules are mandatory income distributions, single principal and income beneficiaries. The beneficiary must also be a U.S. citizen or resident, and there's also an election. You must timely make that election. It's around 2 years after death. So you have a grace period in which you can decide which one to do. The other option is an electing small business trust or a ESBT, also under the same code section. To retain S status under that section, it requires also compliance with some rules. It needs to be structured properly. It is different in the sense that it can have multiple beneficiaries, unlike the QSST. It's easier to comply, but it has less favorable taxes. It also has an election that must be timely filed. So you need to make sure that you're aware of these. The elections are made properly, and that way it won't destroy an otherwise, profitable S Corp LLC. We did also talk about the 754 election, and that was an income tax issue of having inside-outside basis. So I'll leave that to the video in which we talked about it. And we didn't really get into pass-through taxation, but I can do a quick 30 seconds on that. Basically, C Corps, they have their own 1120 that they file, and they pay taxes. Distributions get paid to investors or shareholders, and those shareholders pay tax. And that's why it's double taxation, because you have the corporation as a whole, as an entity, is paying tax, and then that post-tax money is distributed and gets taxed again. For smaller businesses, there's the S Corp and there's the partnership that are called pass-through entities. And what happens with these is that they file informational returns by way of an 1120S for an S Corp or a 1065 for a partnership. It just says, here's the partners, here's their percentage of, or their pro rata share of profits and losses, unless otherwise contractually agreed upon, in the spirit of that substantial economic effect I've alluded to many times in our videos in this series. And those 1065 or 1120Ss have a K1 for each partner, and those K1s, they get attached to those respective partners' 1040s, and the tax that derives from that asset is reported on the 1040 and paid at the personal rates, not the corporate rates and not the trust rates while you're alive. If it's an irrevocable trust, it's a whole other story. They have to pay adverse taxes, much higher amounts and thresholds, much higher amounts at much lower thresholds. And there's ways around that with proper professional advice and planning. So an LLC does not get punished in a pass-through as long as you can properly plan for and distribute the income. As I mentioned in a prior video, partnership tax was one of the most complicated of my courses ever taken in law school, computer science, and tax. Tax is a complicated area. You want to have the right professionals advising you in the trust context, as well as the LLC, and then of course the tax context. So hope you found this helpful. Subsequent videos are going to be, interesting on various topics, and I tie it all up at the end. So thank you for stopping by, and stay tuned for more.